Downtown San Francisco vacancies hit record high. The city nears breaking point. And we know a lot of these downtown cores have elevated vacancies because we've got that whole, during the pandemic, everybody was working from home. It was going to be the greatest concept ever. And now CEOs are like, we need you back in the downtown core. Not everybody's going back. People don't want to go back. A lot of companies are choosing not to go back because their downtown, areas like San Francisco and like Portland have become absolute hellholes that nobody wants to go there. Businesses are leaving. They're not moving in there. Well, San Francisco, it's got a really high vacancy rate. Yesterday, I did a podcast on one of the first major high-rise developments being developed that the developer said, you know what? I'm going to reimagine and rethink. I'm moving forward with this project. They gave it back to the bank in deed in lieu of foreclosure, which just basically means, hey, here you go. Good luck with that. All right. We're going to move on to other projects that we think long-term can be profitable. That one that you just took back, not so much. So you've got these elevated vacancy rates, which means the space isn't being used. So what you've got is this cycle of doom. That's what we've kind of been talking about. You got the cycle of doom. What's going to happen? Well, San Francisco is going to have an $800 million budget deficit. It's going to be close to $1 billion short. Meanwhile, these folks in San Francisco are like, no, we're going to give out $5 million in reparations to everybody who deserves it and qualifies. Yeah. And wait a minute, you guys are upside down on your budget. So what do we got going on? We're going to approach it from the commercial real estate standpoint. We're going to be talking about the downtown core. I know it's not sexy, but I'm going to make it as sexy as I can for you because this is what's going on, not only in San Francisco, but in a lot of areas across the United States, that their downtown cores aren't operating quite the way they should. Let's get into it. Let's see what we've got going on. Here we go. The news and the numbers are grim for downtown San Francisco's office market, and no one can say with any certainty where the bottom is. So we've got a situation where you've got these vacancies and we've got a market that's on the decline. You might say if a bunch of these properties go back to their lenders are mid-sized regional banks and they could have some issues. So is the commercial real estate market the next domino to fall? I think it is. I think we're on the front of it right now because what's going to turn around this whole work from home concept that so many companies have embraced? Because let's be honest, if you have to spend money on an incredible amount of rent in downtown versus having all your folks work from home when you figure out some kind of hybrid work situation, which one are you going to do if you're in charge of budgeting and half of your budget goes towards rent as a big corporation? You're going to figure it out. You're going to retain a little bit of that corporate space so you can have meetings and whatnot, have an address, do that kind of thing. But you're not going to have the big Mac Daddy office space you once did. So you're going to have some impact on, vacancy or occupancy rates in the downtown. So I don't know where the bottom is. I think you're going to have a real day of reckoning. And in the first quarter of the year, office vacancies were the highest ever recorded. According to real estate broker CBRE, the firm estimated a 29.5% vacancy rate last quarter, substantially higher than rates seen during number one, the dot-com bust. All right. That was not good. I don't know if you remember that one, 2001. That was a wally banger. I mean, people lost a lot of money because people were day trading. Remember that? That was the beginning of the day trading. We just had that massive bust with technology companies, right? And so number one, substantially higher than the dot-com bust. And number two, substantially higher than the Great Recession. The Great Recession, 2008 through 2014, whatever. And a sevenfold increase from the start of 2020. Sevenfold increase. That's exponentially higher vacancy rate, right? So then, and start of 2020 is when the pandemic began. Remember, about March 15th is when the pandemic began in my head. It happened a little before that, but that's when our genius of a governor said, we're all going to stay home. We're all just going to stay home. 15 days to kill the curve, whatever it was. Crush the curve, flatten the curve. Real estate analysts are expecting vacancies to tick up further as leases, including a major glut of shorter-term subleases, expire in the coming years. So what you've got is a whole bunch of space that's been subleased out, right? So you got a big company that comes in, takes down, call it 1 million square feet, whatever it is, 500,000 square feet. They sublease out a bunch. So they're going to bring another couple of companies that come in and, all right, we don't need this space over here, or our plans have changed. We're going to emphasize more in this city. So we got this space here. A lot of that stuff is going to come up for renewal. And if it, the sublease stuff doesn't come up for renewal, then it goes straight vacant. And then what you've got is that cycle of doom that we talk about, the doom loop, which is now the city, which already has a $800 million budget shortfall, it's going to have less tax revenue to run all these services, including things like Metro to get people from the burbs into downtown. Well, now you got a bunch of nut jobs on the buses smoking fentanyl. That's happening left and right. And you got people being assaulted. Now you've got even less money for security on the buses. So there's all this stuff. You've got all these boarded up stores in the downtown core because there aren't enough businesses, big businesses in the high rise open to make a go of it for the small businesses, the delis, the foot repair shops, the laundromats that are there. Hey, I'm just going to go pick up my dry cleaning. The mini marts, I'm going to go grab a quick sandwich. The delis, I'm going to grab a sandwich. The bars, hey, I'm going to go get a drink with Johnny after work. All that stuff is kind of gone. So people aren't, going into these downtown areas like they once were. And so all of that, the tax revenue from that is also gone. So you've got this doom cycle, right? Real estate analysts are expecting vacancies to tick up further. Yep, we talked about that, including a major glut. More dominoes could fall if building owners faced with lower revenues decide to hand over their properties back to lenders, many of whom are already distressed regional banks. Boom. That's where I think it's going to go sideways. So if you've got a 30%, vacancy rate, that is lower revenues coming in, period. Not only to the owners of these buildings, not only to the, owners of these companies, you got lower revenues coming in, but the city, its tax base is so dependent upon downtown core, and you don't have that. So the whole thing just, gets out of hand. And so now you're facing a situation where if you've got a lot of debt, if you've bought that property, and the property I talked about, I think it was yesterday, had a big 44-story high-rise tower that a lender decided they'd bought it in 2017. And they decided, looking into our magic, crystal ball, doesn't look like we can make money off this project in San Francisco. There aren't enough businesses that want to rent it out. And it had started out as condos. Well, people don't want to live in the downtown anymore because it's kind of a ghost town and you got a bunch of whacked out drug addicts running around. People don't want that, right? They don't want that in their life. Some people do. You always run into these people. I don't think it's that bad. It's not that bad. And there's a major discussion right now in San Francisco. Well, the data says that it's fine. Well, then why is the mayor begging the federal government to help out? Because there's so much criminal activity, and they're calling it a lack of police officer shortage crisis. I mean, never mind. You've got crime just elevated. You got drugs, all these things that, citizens of San Francisco, they voted in. Now you're seeing the end results. Now you're seeing choices, actions, accountability. Nobody's accountable for this stuff. People are going to be accountable. These banks, they're going to take back these properties. Yeah, I'd really rather not take that property back. You know what? Somebody's going to make a crap ton of money that times this cycle, because it's never really about location. It's about market timing, isn't it? So somebody is going to figure out, all right, we finally got a mayor in here that might do something. Okay. And this could be years down the road, because major downtown like San Francisco, it's going to come back. How long is it going to be? And you might disagree with me. That's okay. It's going to come back to some extent. Somebody's going to get in there and start switching things around. It's going to be a long time. which, I always talk about. Podcast for days. So we'll have a turnover like anything in the history of commercial real estate in the next 12 to 18 months, said Mark Ritchie, a commercial real estate broker with Ritchie Commercial. That could be. I could see that happening. You've had interest rates spike, right? I mean, you had residential mortgage rates double in a very short period of time. It just basically, cut real estate business just down to the bone. We've had very, relative to where we were, our activity has been way down on the Summit Properties Northwest side. It's way down on the Reynolds and Klein side. Actually, of the three businesses that I own, this one right here, Fight Club Media, which produces news for reasonable people, it's doing pretty good. You know why? Because I got these stories for days and you guys are watching them. Thank you for watching. Thank you for subscribing. Yeah, I've had a lot of folks tune in recently, and it's been one of the few positive things I've had going on recently. My kid dies of a fentanyl overdose. Ugh, still working through that one. It's brutal. So 29.5% vacancy rate. And I have read 32, 33% is probably more realistic. We could be at 40% vacancy rate in downtown San Fran. We could be at 40% vacancy rate in downtown Portland before you know it, because the elements that are out there that are happening, all the factors that are happening, those are long-term factors to switch around, to move around, to get headed in the right direction. I don't think we're going to make these changes anytime soon. Plus, the whole work from home thing has really rocked things. It's whether you believe it's, the best way to go. And I want to work in my pajamas forever. We're not headed that way anymore, but it's had enough of an impact. So say you even lose 25% of all that office space that you used to have. Can you still make the numbers work? Can you still operate your big commercial buildings? Is there enough foot traffic for the smaller, businesses to make a go of it? Is there enough revenue where these cities don't go under? That's the big question, right? And that's what I think we're on the forefront of looking down at and going, I don't know. You hear a statement like this one. We'll have a turnover unlike anything in the history of commercial real estate in the next 12 to 18 months. Here's what I would say. Maybe, but in the back of my mind, I'm like, that dude could be right. If that does happen, all bets are off. All bets are off. That could be, you could have the federal government stepping in masse to prop up these small, mid-sized regional banks, because that's who does the majority of lending in commercial real estate. You don't have a Fannie Mae and a Freddie Mac because those are just residential that provide liquidity in the secondary marketplace. You get a mortgage at your local mortgage banker or broker. They broker it to somebody else. They package it up, sell it to Fannie Mae, Freddie Mac. They bundle it up as security. They sell it to you. You buy it. It's got a bunch of tranches that have just terrible, terrible debt in there. And then, everything goes sideways like the Great Recession. That's literally what happened. Swimming in subleases is our next section here. An analysis by the real estate firm Cresa found that the San Francisco metro area is unusual in the amount of sublease space in the market. Much of that is driven by big tech firms, which occupied huge campuses before the pandemic, later putting space back on the market as employees opted to work from home. In terms of the percentage of overall office inventory available for sublease, San Francisco has the highest of any metro area. San Francisco really became a tech market, so we had an over-reliance on the one industry most readily adaptable and embracing of remote work. That's why San Francisco's downtown core is so decimated, because all those people are like, if I don't have to go into downtown, I'm out of here. If I don't have to commute into downtown, I'm going to go somewhere where my housing cost is 50% less, 60% less. I'm going to work from wherever. That happened. And this was said by Mark Guestreiter, an executive managing director at a commercial real estate company, Newmark. Last year, the top 10 subleasers were all big tech companies. Now, which companies lately have been laying people off? Amazon, Facebook. Yeah, tech companies, right? We've got a tech crisis. We got a tech reversal. What we had, tech industry was hiring people left and right. We had cheap money floating around and tech expanded with that money. Now that money's not so cheap. They're laying folks off. So not only do you have commercial real estate issues, you've got employment issues. You've got boats that are being rocked in the tech world. These companies are like, okay, moving forward, not really sure how many folks we need. You got the kind of this reversal. So it's all happening at once. Subleases in particular often offered rent discounts, more flexible lease terms, and lower costs to get the office ready for an occupancy. Because you've already got somebody that's on the hook and they realize, oh, we're not going to be able to take this down, yet we're still on the hook for it. So we're going to discount it a little bit, get that next company in here. So at least we don't bleed out this entire amount each month or until the end of the lease is up, right? But that doesn't mean sublease offers are flying off the shelves. Derek Daniels, research director at Collier's real estate company, said that sublease space would typically be on the market for 5 to 6 months before being snapped up or pulled off. But throughout the pandemic, that time is dragged out to around 14 months today. And that is probably expanding. It's expanding further out as more stuff comes on the market. It's going to take longer and longer because you're dealing with absorption rates, right? The current office sublease in San Francisco have an average term remaining of about 3 years. So once they expire, the spaces would become vacant unless reoccupied. Cresa data shows that around 4 million square feet of office space will have subleases expire by the end of 2025. So that's something that's in play, right? These big companies took down a lot of space. And then during the pandemic, don't need that space. All our employees can work remotely. Until they realize, oh, productivity has dropped. We need that synergy back. We got to get people back to the office. But there's going to be a certain percentage that just aren't going to come back. They don't want to commute. They don't want to whatever. Companies have made adjustments. We're expecting things to continue to get worse before they get better, Daniel said, adding that economic trends like growing unemployment and federal interest rate hikes are also contributing factors. You got that. Mainly the interest rate. So I think what will happen, I think you will have some sort of banking crisis, and then the Fed will reduce, they'll drop the Fed funds rate. We'll go through this cycle of, well, we overreacted earlier when we did that because we were overreacting to inflation that we didn't recognize early enough because we were told that it was only temporary. But it was temporary for long enough where we had to do some really quick interest rate hikes, and that's what they did. Eye of the storm. Real estate sources said that while tenant interest was starting to recover at the beginning of the year, the collapse of Silicon Valley Bank put a freeze on a lot of companies' plans. That was a major indicator of issues going on, right? Issues. For commercial landlords, continuing vacancies could lead to a breaking point. With refinancing growing more difficult, there are signs that some landlords are deciding that owning real estate in San Francisco is no longer worth it. Prime example was real estate firm Redco Development and its investment partner AEW Capital Management walking away from the historic 1 Montgomery Street building that they purchased for $84 million in 2019. Now they can't do anything with it. They've judged. Now we're 4 years later. They're looking at the market going, oh my gosh, we don't want to build this bad boy out. Yeah, no can do. Moving forward with this one, we would just go under. So we're not going to do it. So they've analyzed it and they said, cut our losses. And I think that's where, existing office stock and also proposed and, development deals in the pipeline, those are going to take a real whack. I think we'll see more of owners saying, this doesn't make sense anymore. I can't pencil this. I'm going to do a deed in lieu of foreclosure and give the property back to the lender, said Jana Luce, managing principal at Cresa. And that's literally one of the podcasts I did yesterday is exactly that, deed in lieu of foreclosure. Not as bad as straight foreclosure, but it's bad. Better, and it's definitely worse than a short sale. And those are residential terms. You're probably going to bankrupt a corporation when you're talking commercial stuff. So it's not quite the same as, it impacted my credit score. My credit score went from 750 to 625. Transactions have slowed significantly as office owners contend with the reality that their properties are worth far less than they were just 3 years ago, with some buildings trading hands at huge discounts. Commercial real estate is based on taking the income, multiplying it by a multiplier, and there you go. There's your, or dividing it by an indicator, and there you go. There's your value. Well, if your income is way down, that value is going to come at a huge discount because the building is no longer worth it. It's just based on straight income, right? You've got, expenses and stuff, but those are fairly easy to qualify. And if you just flat don't have the revenue, that's when you say, hey, looking around at this doesn't make a lot of sense. Gap Incorporated sold its building at 1 Harrison Street to the Sobrato organization for around $80 million in February, which real estate experts say was around a 40% haircut compared to what the building would have fetched before the pandemic. 40%? You can't tell me with a 30% vacancy rate and 40% haircut, just as an example, that moving forward, everything's going to work out hunky-dory. Don't think so. Here's another one. Another possible sale that could set new precedent is the Union Bank building at 350 California Street. Sources say bids for that building have come in at around a quarter of its $250 million pre-pandemic value. A quarter. So like 70 grand, 60 grand, something like that. Yeah. 65 grand. Something like that. That's crazy. 62.5, right? In a sign of the current state of the market, those offers are currently being entertained. They're looking at them because something is better than nothing. Maybe they can cover some of their investment. That's what they're looking at doing. Getting out. Trying to figure a way out, working the way out. There's growing concern that real estate troubles could further damage regional banks already battered by the collapse of Silicon Valley Bank last month. So, yeah, that's basically what you've got going on here. So moving forward, yeah, there's some pretty major issues. You got in San Francisco, you got the sublease deal. You got an interest rate deal where things are way more expensive, not only for the companies that need this money to keep going, but for financing of these projects. You got the whole work from home deal where companies are doing more of that, having fewer people in the downtown core. And we haven't even really touched on people don't want to be in downtown San Francisco because there's just a bunch of crazies running around. You got people that are addicted to drugs and, doing criminal activity. And, we saw that during the pandemic. We saw a lot of that, just things going wild. Example of that is right here. Bizarre vandalism incident halts San Francisco Board of Supervisors meeting. Yeah. Here's what happened. So Board of Supervisors is in, call it a town hall. It's in this big building, and they've got to, per law, they have to televise their meeting. Well, outside, some total meth head, some crackhead, let me show you this, decides to rip into the Comcast cable box, destroys it, just yanks out all the wiring. They lose their cable. So does everybody else in the area, including people who need it for work. And they have to reschedule their supervisor board of supervisors meeting. Yeah, got to reschedule. Can you guys meet up tomorrow? I don't know if you had anything going on, but that crackhead, that tweaker out there just really tore into that Comcast box. Can you believe that? Yes, I can. It's San Francisco. That's a prime example of the nutcakes running around downtown San Francisco and why businesses don't necessarily want to be there. You can't really blame them, right? Talk about an interruption to your business. There's a few things in business that shouldn't get impacted. You hear commercials about, do you have secure internet? You hear those commercials like, yeah, whatever. They try and scare you into buying their thing. Well, talk about not having secure internet here in San Francisco. Do you have secure internet? Yeah, most of the time, except for, when those crazy tweakers just tear our box apart. Then the guy's got to come out and fix it. The cable guy. You saw that movie, right? Yeah. This is what you got going on. This is what people of San Francisco have voted in, and they're getting to work with it now. And now, on a larger scale, it's going to impact a lot of what's going on in downtown San Francisco on the commercial end of things, because you got some big ticket items that are pressuring that. And then you got some local, micro economic stuff that's going to impact these commercial projects as well. So stay tuned, because I'm going to cover it as it unfolds, and it will unfold one way or the other. Make sure you subscribe, hit that notification bell, share the content. Check out our Reasonable Plus Discord channel. We've got some new stuff going on there. You should check it out. It's free. Also, we've got reasonabletv.com. That's our paid subscription site. That's where I've got the stuff that gets censored elsewhere. Thanks for checking it all out. I'll catch up with you on the next one. Bye for now.